Summer in New York. Knicks move on, so we got that. And then, as I wrote in my Substack this week and talked about with Anthony Pompliano, it's Kentucky Derby Saturday, so I'm going to put this in before I go sit down and enjoy the race and hopefully make a little money. So, bear market rally continues. Most hated rally I think I've seen, but only because I haven't seen anyone that can possibly buy into it. Stocks rally, sentiment doesn't. That's basically what I'm talking about in terms of as I'll go through it. For those of you who've known me a long time, I'm a huge believer in Bayesian theory and using it for thinking about markets. And the Kentucky Derby with my father is where we really developed kind of the thought process before I knew who Thomas Bayes was. If sentiment is bearish, the question everyone should be asking, who I asked on a trip to London this week, who do you think is buying? Debt problem still exists, so regardless of what is going on, I still believe that we've got a lot to this tariff story over the next few years, as I've talked about. A big week again in humanoids in terms of news stories and things in the front headline. And for all of you macro people who give up after the first third or half or 2/3 even and don't spend time on the Bitcoin piece, you either start doing it now or you're going to be doing it before the end of the year, because it will be the best performing asset. And I figure by the end of the year, with the move I'm expecting now, given everything that's happened and what's going on with stablecoins, and I'm going to introduce bitbonds today, and people on the macro side should fast forward to that just to get a sense as to what I think is rumblings that to me are going to be real as time goes on, whether or not they happen. So back to a chart I've shown a bunch of times. I expect the S&P to get back up to the red line, which is, we're almost there. It has the 200-day moving average. It also has the day of the election in terms of the high close the day before the election. So I think we are going to run into resistance. I do think we're likely to have a pullback, but I want you to look at that chart. The reason I did such a long-term one was not just to get the 21 highs in where we had bottomed, but also just look. That don't look like no bear market rally to me. That's a V bottom. So even though I think we're very likely going to pull back because no one's bought into it at this point, and I think macro people, for DeMark reasons and a whole bunch of reasons, resistance up there, are going to sell this. But that does not look like a bear market rally to me. So when you hear this from people, it made sense that it could be one, as an Elliott wave person, that we could be doing one more wave lower. It just doesn't look that way to me anymore. So for people that are saying it is and not adjusting, this is the first Bayesian principle, new information, and no one wants to do it. So a bear market rally, let's use this one as an example. Here are the MACDs. We did go back in 22 and go down. This one just is much stronger than any of the stuff in here, these bounces. It's taken a while. We obviously almost finished up for April, but that's why this does not look to me like that. From a breadth perspective, normally when you have a bear market rally, you're not gaining everyone in. The healthcare, energy, staples, utilities, and they had been doing well before the market peaked, or even while the market was going down into Liberation Day. But this is from the lows. Every sector's up. You're up 12% off the lows. So when it fell 10% in 2 days, we heard about it. It's rallied 12% in the back. And tech obviously led the way where it led down. This is the bear market rally that I hear most people, when they reach out to me, say, well, this is just like May of '08. And I'm going to show you why it's not. The first one is, again, from an Elliott wave perspective, this is very much like salmon swimming upstream, and that's what the Elliott wave theory is for. This is impulsive. This is corrective. This is impulsive. We are not seeing those types of moves since the low. This has been a very impulsive move up. I've shown each week a variety of different things, but that's where people think DeMark is going to get people to sell it. And like I said, I think a lot of people are going to try selling it this week. Claims. This is the main reason why, again, there's no recession. There's no signs of one. There's zero there for everyone who wants to pretend that there is a recession or that there will be one. There just isn't, and I'll go through why more and more. But I just want to remind people, in May of '08, a bear market rally, we had gone from 300,000 claims and trended higher consistently, and we got all the way up to 370. This was the Bear Stearns situation in here. So everyone thought in '08, having traded there, this continued to go higher. So right off the bat, The claim situation's not there. Junk spreads, the bigger thing. Again, in '07, junk spreads started to move higher, and they just consistently moved higher. And again, this is into May of '08. You'd gotten up to spreads of 640 basis points from 200. Right now, we've gone from 200 to 227, and the white line here is the triple C's versus high yield. There is nothing in credit. So forget just claims. There's nothing in credit to say that. What is unique is that the bearish sentiment doesn't budge. So the S&P has rallied. This is, again, the impulsive rally. Bear sentiment, this is the 5-week average of the AAII, has not budged. I don't even know what to say. Here's the 5-week average. We're at 57.7, the highest on record except for one week in 90. So bearish sentiment has not changed, which is not normal. Here is the bearish sentiment. And again, these are inverted when they're down here with the S&P. This is the 2022 period. It just followed with it. So think about it. We got a rally here. Well, obviously sentiment, people started getting less bearish. It followed it every single time. In 1990, exact same thing. So during that period that I showed the bearish sentiment, when the stock market rallied, the bearish sentiment actually got less. Most importantly, for the May of '08 crowd, who keeps telling me that, we only had 25% bears. We have 60% bears. So this is a very unique situation in sentiment. The other place where it's unique is that this would be the first time in 30 years where the amount of stocks above the 200-day moving average with inside the Russell 3000, which was below 15%. So times below 15, where then we get back up to 30. The only time where we went back down here and made new lows was in this period in '09, the great financial crisis. And so this is Bear Stearns. We go up and then we come back down. For this to happen again, we need to lose millions of jobs, in my opinion, and we need to have a credit contagion. Those don't exist anymore in this day and age. There are no such things as recessions anymore. So everyone who wants to keep playing this game, if he keeps the tariffs at 145%, I still don't believe we'll have a recession. I do believe we'll have lots of bankruptcies. I do believe the government will have to get involved. But you are making so many assumptions to get to recession that for everyone that I've seen and everyone's talked about it, it's just not real in this day. And I won't continue to go through all the structural differences that have occurred. Some of them will show up. Soft data versus hard data. This is going to get into, do you really think getting into a recession is on the front page of the paper? When it's on the front page of the paper, meaning everyone knows the hard data is good and the soft data is bad. Soft data, again, for people watching for the first time, that just means people are worried. If the tariffs continue to go the other direction, second derivative policy continues to ease, which has been happening, people will get less every single time worried. And as they get less worried, they will realize that they don't have any skin in the game at that point, at least on the hedge fund side, but also in other parts, businesses, stuff. People are just worried right now because they don't know what's going to happen. So the uncertainty index. I brought this up because will Trump tariffs spur recession? 4 chief economists weigh in. In all of my days, no one has predicted a recession ahead of where it's going to go. Economists do not predict recessions. That's why they're all at 50. But we've been talking about it now for weeks. So if people think it's not built into prices, I don't know where everyone thought it would be that easy. You could just read the paper and do what it says. Empty shelves and layoffs. I've heard this 12,000 times. Bayesian thing. Critical thinking is an active and ongoing process. It requires that we all think like Bayesians, updating our knowledge as new information comes in. Trump announces 90-day pause on reciprocal tariffs with exception of China. Bayesian principle. This was April 9th, basically the lows. He pauses, the market rallies. This is after every day, didn't care about the stock market, didn't care about anything. We need pain. First, move the other direction, and people are still as bearish as they were then. This comes out this week. I would be surprised. This is the architect of this whole plan. I would be surprised if tariffs don't change in a few weeks. It has been clear there will be a deal with China. I don't know how. Stephen Mirren does not have the ability to go out there and speak for himself. So this is from, again, the White House. Now, again, it is rhetoric, but I think, again, it shows that they're not setting the market up for disappointment. There is going to be something that goes on, and every day there's a little bit more moving in that direction. In terms of job losses, we got the payroll number. Again, for people betting that we're going to have a double dip in the S&P and we're going to head down, this is what needs to happen. This is 01, 02. There are no recessions since the point that I said the entire economy has changed because of the iPhone, because of the baby boomers retiring and the transfer payments now becoming 15% of nominal GDP, handouts, UBI, given out to people, the distribution of wealth. We've had a massive stock market gain. So the wealth just are basically driving consumption along with the UBI side. And as I go through this, you have business investment, which is coming. We will have a slowdown in growth, but to get into here, you're making a huge, huge leap, which doesn't exist anymore when you throw in the contingency workers. I will continue to say whenever a recession has been built up to 50%, the one thing you want to do is buy, buy, buy. This is what Nick Timmeros put out, and again, I've shown this before. I only use the aggregate number, so he's using the aggregate weekly numbers, and the reason this is important is because it does include the other components of the weekly hours, which have been weaker, and the wages, which are coming down, but it's going sideways exactly where it was, and this is overlaid now with nominal GDP. You cannot have a recession without people losing jobs when we have this wealthy of an economy. It's just not possible, since 70% of consumption, or 70% of GDP is coming from consumption, and consumption needs job losses to actually have a recession. This was brought up to me a lot. I want to just address this finally. Every time one of these surveys comes out and people sends it my way, look, there's no CapEx. Guys, please, small businesses are not driving this economy. There are 7 companies which make up the majority of the revenues of the country, and they have tons of cash. They are spending money, and they are the ones driving. So if only 7 companies do not change their CapEx attention, BCA Research, which I've loved over time, the people that do this work, they are just bearish, bearish, bearish. The reality is, to use these diffusion surveys, it's not just soft data. You could have 70 businesses say they're going to cut CapEx, but if you have a massive distribution of wealth problem, if you have the Russell 2000 total market cap be smaller than Apple by almost 2 to 1, what is the purpose of diffusion indices? That is why we are in this trouble with the tariffs. That's why Donald Trump got elected, because the majority of people are not participating in the economy. This is just logic. This is not something intelligent. This just means that you can't use these surveys to forecast doom and gloom. So let's go to more Bayesian principles. Every single time someone writes a negative story on Microsoft, go use semi-analysis and don't use the sell-side places that have sat there every single time doing the exact same thing on Microsoft isn't spending on data centers. Go look at what's actually happening. This is where social media ends up being a huge negative. People have so much information coming in, I don't even think they do their homework on this stuff. So what happens? Microsoft basically says, in their earnings return, demand is growing faster than supply. It accelerated in the quarter. Expect capacity constraints post-June. Trying to get more data center capacity online to satisfy demand. This is from Satya Nadella. The people who put out the bearish thing that you believed in it, they don't turn around and then say, hey, I was completely wrong. What happens with Meta? We anticipate our full year 2025 capital expenditures. We're raising it to $72 billion. Meta also said there's a compute shortage, even with the CapEx guide up. So even the capacity we're bringing online, we're having a hard time meeting the demand. I've gone through this every single week in terms of insatiable demand for it. DeepSeek didn't do it. So think about when this whole thing started. It started with DeepSeek. So everyone has become bearish, and now they're ignoring the fact that everything being announced by these people is just not true. Google reaffirms its CapEx. So forget the earnings side at this point. Just go through. Morgan Stanley turned negative after the DeepSeek on the entire semi side. So when they come out and they boost fiscal year 27 revenue, because inference demand's exploding. I've covered inference here. I did it on the embodiment research I did for 22vresearch.com. Their revenue, they're now saying, is going to be up 10% higher. Now, again, this is fiscal year 27, but inference is exploding on the demand side. It takes more compute. So now I just want to go back through the earnings and make sure that you guys get this, because this fits in with the Bayesian side. It fits in with the economic side for forecasting a GDP. Walmart, here's their quarterly revenues. This is Amazon now. So again, Amazon surpassed just now. But I want you to see back when the great financial crisis happened, this is how the economy has changed. This is how everything in the market has changed completely. Apple's revenue were $25 billion. Here's their revenue estimate for this year after the end, $413 billion. So Amazon was at a point where that's about 400 or more than 400. Yeah, it's about 400 billion annual. This is 400 billion. So you're up at 800 billion in revenues from those two companies. Microsoft 300 billion. Look where they were back in '07, 58. Go try to find companies that have had anything. These are numbers that are just massive. They're bigger than most companies. In fact, if you take Google's right now, the largest market cap in Europe is not as big as the revenues that are created by Google, Apple, and Amazon at this point. So again, the economy has changed globally, and it's not something about US exceptionalism. Those companies have dominated, and they just reported, and nothing is collapsing, and they are still spending the money on CapEx. So you have to make an adjustment. Now, where does this show up? In fixed investments. So this is the GDP number, down 30 basis points. Oh, must be a recession. Personal consumption, 1.21, and this was a decrease. So normally, I mean, this is something that's down. We're going to stay on the consumption side until people lose. So you're going to get that as a positive. Inventories are obviously going to change because we did a front loading of inventory, so that's why this went up. At the same time, net exports collapsed because we did imports, so you get this offset there. Government spending, believe it or not, was negative, so we're actually getting a negative side from here. Look at where government was. Look at where it normally is, positive. So we are getting the negative side. The problem is fixed investment was massive. What is fixed investment? Well, a bulk of that is the AI CapEx. That's where it goes in, and that's where you're starting to show the number. So the problem is when you try to do this, if they spend $300 billion, if nominal GDP this year grows 4%, that's $1.2 trillion, of which 25% you have now been told by these companies that they will spend at least that much this year, and they're running into shortages already. So how do you fade the economy without job losses? So again, I'll keep saying it, between AI and consumer, you cannot have a recession that matters. So just keep going through and just keep looking at the jobless claims. If they start to go higher, we're in there. In terms of the austerity stuff, this is not something. So we were all worried. Steve Cohen gave a presentation, was very timely in terms of this is going to be austerity. Well, here were the bets on federal spending cuts. Doge, back then, $250 billion. What are they going to do this? We're down now to 3% on the betting polls, or 10%. We're up at 40%. So we don't turn that as a positive. There's going to be less austerity. And to show it again, this guy does really good work on the accounting side and basically brings up the fact that we're not cutting anything. I mean, when you go through this, as of right now with what's happened and what the fight they're having and trying to get a bill through, there's no spending cuts that are happening. So the fiscal side, the fiscal deficit, which we had heard they were going to work on, that's not happening. We've got rates higher, so they're kind of screwed in terms of doing anything. Everything has changed. You have to take a Bayesian philosophy and adjust to the new data. And the new data relative to where it was before the market fell has all softened. It's all gotten better, or it all hasn't turned to the abyss. So if we get deal announcements and we get something with China that leads to some reduction in the 145, everything is going to be very different, and that's why the market has rallied. It's looking towards the second half because the probability of all these things have changed. In the spirit of the Kentucky Derby, that's the way I was changed. When the odds are changing because a horse had something happen or the betting pool goes through, you start trying to reassess what you think. And in this case, people are not reassessing. I hear the same things I heard before the market fell 10%. Nothing mattered in terms of price, and now we're back up to those levels. Earnings growth for the first quarter, 12.8% at this point, year over year. I mean, so that means that as of right now, the PE and everything about it just continues to get lower. Profit margins, pretty much every single sector, again, AI agents is a story. It's going to remain a story. You're fading profit margins. Even in this environment, they keep getting better. Here are the earnings, again, for Q1, for Q2, down, and then still going higher year over year, still going higher in terms of the forecast. So if those are right, then the market should go higher. Here are the estimate revisions, which have come down. A lot of this, by the way, now is also due to energy because the oil price has fallen so sharply. So a lot of the revisions that have happened that have skewed things for the past couple of weeks have been drawn by that. I just want to bring this up because as long as the earnings are growing and profit margins remain steady, you all hear PEs. For those of you who've heard me speak on crypto, I don't believe any company has a value 5 years from now because of AI. I think it's so murky that all PEs are ridiculous across the globe to go through. I think commodities and things that are hard have a good side, but anything related to software, anything can be disrupted by AI. I don't know how you value them out 3 years. So all of their PE should soften, but it should happen when the growth rate goes down. So I would start using PEG ratios for the S&P 500 as a better gauge. And right now the PEG ratio relative to history, right in the middle of it. So I really don't think the market in any way, shape, or form, the way I'm looking at it, is overvalued. Now we're going to segue into something important. And I mean, again, the market fell. You try to figure out who's buying. Apple announces a $100 billion buyback. Just hard to fathom how big that is, larger than the market caps of 406 companies in the S&P 500. So again, let's assume all 406 companies, that's their market cap, say the economy is bad, but Apple has enough money to buy $100 billion buybacks, bigger than 406. The biggest company in Europe is less than 400 billion. I mean, they can literally buy Nike, Starbucks, or DoorDash and still have over 10 billion cash and still buy back their own stock. You're just getting to the point where these numbers are ridiculous. So you need the Mag 7 to be the problem, and that's what they've been, because the S&P x the Mag 7 is up for the year. The rest of the world is up for the year. So it's a bull market everywhere except for the Mag 7 at this point. And they just reported earnings and everything is fine. And in Apple's case, they had the worst stock reaction, but they're buying back tons of stock. It's not just them, though. You're fighting this. This is what's buying. Having worked at Morgan Stanley and knowing that the buybacks keep coming, and they love to buy on down days. They love to put their order when the market opens down, which means all of those times where the market closed above the halfway point or at the highs of the day, which has been the majority of the days since the lows, we open down, the buybacks come in. We're talking about $1 trillion of buybacks. So the volumes have come down. The fact that we went all the way back up to where we did on no volume, and it took an enormous amount of volume or energy to get us down, just shows that the path of least resistance, regardless of what people think, is higher. Buybacks are real, and hedge funds will turn around and buy once the news gets them off of worrying so much. Buybacks accelerated week over week and tracking above seasonal levels for the fourth week in a row. Retail's been buying. I'm sick of hearing from people that retail is stupid. Retail does this and has been doing this. They've been buying zero-date options. I will keep saying the same thing I've said. You're missing the point on retail. They are gamblers. And what do gamblers do? They look for situations where they can make money. This is like card counting, guys. The S&P 500 has been up 85% of the time during their gambling time. Maybe someday it'll go down. But the reality is they buy, it falls, they buy, it falls, they buy. And yes, they keep buying. It's the way that the market has been, and it's the gambling nature, but it has paid off. And true gamblers know they're going to lose. It becomes a volume game. And if you find anything where you have an edge of 85% over the long haul, you just keep playing and you'll get your money. It's simple math. And until they find not just a bear market, but one that actually stays down for a long time, retail matters. They're an important component in this. And to show you how big, that was $200 billion in gambling a year for the PCE, so of the GDP. It's now bigger than new auto sales. This is the quarterly numbers of new autos. So if you haven't noticed what's been happening, new auto dollars gone down. A lot of people buying used cars. You've got cars are staying for longer periods of time. But I'm just telling you, gambling has gone straight up over the last 20 years while new autos has gone down. That is a demographic shift, one of the things behind Bitcoin. But I'm just telling you, this is to mock retail is not there. We still have systematic equity positioning at the 6th percentile, according to Deutsche Bank this week. You didn't want to be short down here. You didn't want to be short down here. You didn't want to be short down. I don't need to go through the whole thing at this point. Goldman Sachs said under all scenarios over the next week, they're going to be buyers. Over the next month, massive buyers. So again, something needs to change. Pension funds. Anyone who has a liability that needs to meet some number, let's say 5-6% a year, what are they going to buy? Bonds? This is the U.S. Barclays Ag for the last 5 years. So in the old days, when yields would go down, when inflation was down, and when we used to have recessions, you could buy bonds. If we don't have a recession, which I'm telling you is not going to happen, will we have a slowdown? Yes. Will we fire lots of people? No. If we don't fire lots of people, I don't expect bond yields to go down. because we didn't do anything on the fiscal side. And I think the problem is, again, nobody wants to buy the debt. So the U.S. has said we don't want to be the global reserve currency. The foreigners have said we don't want you to be the global reserve currency. We still have a massive debt problem. I will continue to say the biggest risk for the marketplace is that nobody comes to buy the bonds. And we have to figure out a solution for this, which I'll address at the end. But this is the 5-year performance. So what would you rather own? When the S&P is down here from falling from here, if you're an allocator, you're like, oh, I'm getting a chance to buy the S&P at the same level it was back here, or I could buy bonds. Why would I buy bonds? So many people are still using the old recession playbook with bonds. And all you have to do is read Ray Dalio. Whether you think he's selling books or he's doing whatever, he is doing a lot of this stuff for free. The reality is, I agree with what he's saying to a degree. The changes are coming. I do believe that the tariffs have basically created problems that won't go away, that radically reduce independency with the U.S. is a reality that has to be planned for. I completely agree with him. I do not believe that this can be reversed. And I don't believe that they're going to be able to pull off a beautiful deleveraging. And the reason is because I don't think the global investors are going to invest in the U.S. the way they did in the past. If countries start buying U.S. debt, everything changes. Completely agree. At this point, I think they're going to buy it, but I think we've gotten to the point where the bond market becomes the bigger thing. I'm just showing this because 10-year notes have sat in this range now for a while. There's a big move coming, and if I had to guess which way the big move is coming, I will say it's up as opposed to down. Most people would answer down because they think there's a recession. I happen to believe the risk is that, again, we're going to have an incident the next time that the stock market is falling, and I think it's going to be driven by these two factors. The dollar, I do not think also can be owned. I heard a lot of people trying to pick the bottom in this. A rally in the dollar to me is going to be short-lived. I think the easiest way for people to think about it, I don't think they should be getting rid of U.S. equities. I still think the growth rate on U.S. equities and the dynamic nature of the economy, where we're not doing the austerity, means that we shouldn't be avoided on the stock market, but on the currency side, I think now going forward, they're going to continue to de-dollarize at a faster pace, and the world is flush with dollars. So I think it's still going to be on the weaker side. I think it'll take some time. Again, for the Mag 7, probably the biggest risk that I see, and the reason I like the non-tech side is not just the AI side, but because they get 49% of their revenues overseas. One thing I heard in London, I just think people are going to be on buying less American products in result of what's gone on. So most of our revenues for those companies come, not most of them, 50% of them come overseas. Jumping to the tech side, humanoids, UPS in talks with startup Figure AI. Figure AI is probably the best company in the U.S. to at least read about on humanoids. UPS talking about getting involved. CNBC basically did a report, estimated number of human workers expect to be replaced by humanoid robots by 2030, 500,000, and the numbers go. The only reason I'm showing this is what everyone talks about, every investor I read, everything. This is what the future looks like. So a decade from now puts us out here, 1.4 million. It's gonna be job replacement, but we're gonna have a shortage of people as it is. Bain did a big report on humanoids this week, worth going through. Morgan Stanley came out with a report, $5 trillion opportunity. A podcast to listen to, Moonshots with Peter Diamandis. He did his Abundance 360. Brett Adcock is the CEO of Figure AI, which I referenced. Figure 3, one of their robots launching this year. It's 90% cheaper and production ready for global scale. Demand is overwhelming. 100,000+ robots could be deployed today if supply allowed. $300 a month is the price target. Again, 24/7 autonomous labor as affordable as a leased car. This is not a 10-year vision. Robots at scale are coming this decade. Bitcoin, final part of this presentation, best looking chart out there. We've already blown above the 200-day moving average. New highs are coming soon, in my opinion, very soon. Here is what has happened in Bitcoin since the launch of the ETF relative to the Mag 7. Bitcoin is up 207%. Mag 7 is now only up, up 107%. It's doubled. And the Mag 7 is now only up 44%, which is where it was back here in July. This gap to me is going to continue to widen out this year. I do not think the Mag 7 is going above the highs. So I think we are at best case scenario building kind of sideways pattern here. While Bitcoin goes higher, this is going to drive a lot of people into the market. And part of the reason is 60-day vol on Bitcoin. You hear how volatile Bitcoin is. It's coming down. The Mag 7 has been coming up. They're both around 50 right now. This is a big deal, and part of the reason it's a big deal is because we just had correlation. Look at the correlation, stocks, bonds, and the dollar. Bitcoin is a global asset. It's not a U.S. asset. So are the Mag 7. The Mag 7, 50% come from overseas. Bitcoin is a global asset. You will see more and more institutions and retail this year accelerate money. I thought Bitcoin would double this year. My estimates based on the unintended consequences of the tariffs are much higher. Anyone who wants to talk about it, reach out to 22vresearch.com. I will spend the time on why this macro asset you need to put your time in now, because it will be providing alpha in portfolios, as it has been with some companies across the globe and more governments to come. The Bitcoin ETF had a huge inflow surge this week. 4 major wirehouses are going to start offering Bitcoin ETFs to clients. I was turned off by Merrill Lynch this year, told I couldn't buy the ETF. Charles Schwab is on a clear path to launching Bitcoin and crypto buying. We have a green light from regulators. Bitcoin's rise driven by institutions, not retail, says Bitwise. They're going out every day and talking to institutions, and more of them have been doing their homework, and they're starting to put money to work. That's why there's a bid underneath all the time. This is not at this point being driven by people jumping into the market. This is being driven by a bid underneath. Arizona State approves first ever Bitcoin reserve. This is in the governor's hands. We'll see if it is approved or if the governor chooses to get fired. Brazil's largest bank, Itaú, basically going to do a micro strategy copycat. President Trump's executive director says there's a space race among countries to accumulate Bitcoin. Now, I'm going to go through stablecoins, which I've talked about before and I brought up last week, and I'm going to say it again. You cannot go into a coffee shop and buy coffee with gold or euros or yen in New York, but you can go in and buy it with Bitcoin. This will continue to be a story I will say repeatedly, and the reason is because you can sell your Bitcoin while you're online, get your stablecoins, and then get it onto your stablecoin card. Visa and MasterCard. So Chamath, who I'm on strike with listening to the All In podcast because of the biased nature of it now, propaganda, I can't listen to it, but he did put this out on MasterCard and Visa, basically continuing to increase the ability for people, not in the U.S., around the globe, to use this for cross-border, but also for transactions. Our best estimate, JP Morgan, is that the market size for stablecoins has the potential to grow to 500 to 750 billion over the coming years. And of course, that would become a massive buyer of treasuries, because they're already a massive buyer of treasuries. Stripe, I've highlighted this company many times. Test new stablecoin project is 3.7 trillion market used. That is, again, cross-border. Here is the launch for the Fuse card. Again, this is the Visa, virtual Visa card to spend stablecoins anywhere. They go through this, including off-ramps in Mexico. This is just going to continue to be a story that you're going to hear about. MasterCard adds stablecoin. Again, this is all this week. We announced our end-to-end capabilities to support stablecoins, ensuring payments can be made or received using them anytime, anywhere. So when Bitcoin is told to me it's not a currency, yes it is. You can convert all of this immediately into currency. You cannot do that with other things, and it is global, and you can do it all over the world. So again, this continues to be a situation where it's merging with the fiat system. So it is the new system of the future. The government is totally supporting this. In fact, it is a tailwind behind it. So whatever your negative side was on it in the past, if you meet people or read macro people, just go back and see what they were saying in 2019. And if they are saying the same things now, you should not be listening to them at all. You can believe that it can be hacked. You can believe all of this stuff. That's fine. But to say that it's not becoming part of the system and you should be looking at it as an investment, every investment has risk. Bitcoin's risk, due to many factors, but also stablecoins risk, has gone down. Stablecoin transaction volumes hit 1.82 trillion last month. You want to invest in things that look like this. You try to tell me anything you've seen in the last 5 years of research that looks like that. Nothing in the world from an investment standpoint right now can you find this kind of size with that kind of chart. Venture investors had hoped for IPO recovery in 2025, but now it's on hold. This is something that I'm going to finish up with. So the IPO market is pretty much dead. I've shown how the credit markets had frozen. At the same time that that's going on, there's been a flurry of crypto deals. Crypto deals in value. This is going to be a record year for sure. But what I really want to go through is make sure that every time you hear about MicroStrategy and someone focuses, they always focus on how much he bought. I just want to remind people, the money is coming from investors in the fiat system. He is able to tap the capital markets for massive size, take that money and go buy Bitcoin. That demand is there. So it may not come from you. You may say that he is there, but the easiest way for this not to work is to not have people buy the products, but the products are working. So you're fading Bitcoin, and Michael Saylor just continues to do it. So I will continue to say, he's raising another 21 billion. Yes, look at that number, 21 billion. How many IPOs or any kind of capital market raises, including US Treasuries? $21 billion. He's able to tap the fiat system and market. So every time that you sit there and say it's a scam, every investor, whether it's an insurance company in the convert market or anyone on the equity side that's go look at the holders in MicroStrategy, he's able to do this. So it is not a scam. He's able to tap the markets. He's tapping the fiat system to take money and bring it into the digital system. And I will end with this. Everyone needs to go watch this video because this makes perfect sense to me. And this is something from everything that I've gone through the government could do. So the government can't, remember the tricky words, we will not use cash from the taxpayers to buy Bitcoin. But you don't think that using the Michael Saylor strategy of issuing a government bond, a $2 trillion issuance, where they raise $200 billion worth of Bitcoin by 90% of it basically being treasuries, of which you only get a 1% coupon as opposed to a 4.5%. And then you have some kind of split on the performance of Bitcoin for both the investor and also the taxpayer. That's what this idea is. I went through that presentation. We have to do something on the federal debt market. The new currency market or the new system will involve Bitcoin. In my opinion, before the end of this year, this will be a real story. So for every macro person who doesn't see the connection between Bitcoin and treasuries, Bitcoin and the stock market, I call Bitcoin the S&P 500. I'm happy to sit with anyone and go through this in a clear, concise manner. But if it starts with it's a scam, it's worthless, just don't listen to them. That's it for this week. I'll see you guys next week. Enjoy the Kentucky Derby.